right, well, welcome once again to 5 Homes to Freedom. We are still in Module 1. We are now looking at lesson number 5, where we're going to be talking about your team and who you actually need to have on your team, as well as what makes a good team member, and how do you find people for your team. So I just want to touch on the type of people that you want to attract to your team. What you really want is people to work with you, not for you. You want to attract people with similar mindsets to you, and beliefs and values. You don't want a straight out employee, somebody who's just there for the paycheck. You want somebody who is committed to helping you achieve your goals. And there's a big difference between the two. So share with these individuals what your goal is, get them inspired and motivated to want to help you, and you'll have a totally different team working behind you or with you. So people on your team, some of the members that we're going to be looking at are your real estate agent or agents, property manager, lawyer, accountant, bookkeeper. We're also going to talk about the lenders, whether it be a banker or mortgage broker, your appraiser and what is an appraiser and why you need to have an appraiser. We'll talk about the handy person, joint venture partners, and wrap things up with a coach and mentor. So we'll quickly talk about property manager first. One of the things that you want to find out is how much experience they actually have or don't have. So in different regions of the country, they may or may not need to be licensed. Where I currently work right now, live and work, a property manager does not need to be licensed. However, in other parts of the country, they do need to be licensed, and they fall underneath the real estate brokerage. That means they have to work under a real estate brokerage as a property manager, or they have to become a broker themselves in order to be their own separate company. There's not really the importance of that is just knowing how much education they have behind them and how much experience they have behind them. So if they have a very large portfolio, you also want to know how many people do they have working for them to support the size of that portfolio. If they've got 300, 400 people underneath within their portfolio, and they've only got 2 managers to manage those 400 units, and you try to add more to it, I'd suggest that that's not a good thing, because they may have lots of experience, but they're going to be overwhelmed with the amount of workload. And adding your 5 extra units is not going to be enough to justify another property manager being brought into the mix. Whereas if you've got somebody who's only managing on a small scale 40 or 50 units, for them to take on your 5 or 6 additional units is not a big stretch. Find out who they have working for them and with them. You'd like to get a copy of their management contract, the contract that you're going to sign with them, and just make sure that you are in agreement with everything. You may love the property managers and want them to work for you, but you may not agree with something in the contract. Well, you can negotiate that, because it's not a standard contract that's regulated by anybody. The next thing you want to find out is what are their policies and procedures. They may have them written out or they may not. So what I'm talking about here is when a tenant fails to pay their rent, there's a whole set of procedures you need to follow as a landlord in order to evict them and or get your money back out of the tenant. So when do you start that process, and how do you do that process? You want to make sure that they're familiar with the process, they're being proactive. What happens when there's a violent act at the property? How do they deal with that? What happens when there's an emergency like a flood? How do they deal with that? You want to understand how they're going to be taking care of your tenants and your property. Get a list of properties that they're currently managing and other people that they're managing for, and talk to their other clients, and possibly even I would suggest you go and visit the properties that they're actually managing. See how they're being taken care of. If you can talk to some of the tenants or the on-site staff, talk to them and see how they feel. Insurance is a big one, and for the smaller management companies, it's often not even understood by the management companies, the importance of the insurance. When a property management takes over the property, they become responsible for that property. They're the first line of defense. So in the event of an emergency, whether it be a fire, flood, whatever, they're going to be the people who are responsible for responding and the people who are responsible if there's any accountability. So let's say, for example, somebody gets hurt on the property and it turns out it was because things were not being taken care of in the hallways. The property management company were not making sure that the halls were being kept clear. Well, that liability could come back onto the property management company. Doesn't mean that you as the owner are no longer liable. It just means that the property manager is going to be first and foremost. Therefore, you want to make sure they have insurance and it's adequate insurance for this. You also want to see what their fee structure is. Are they charging 4%, 5, 8, 10%? And is it based on rents collected or rents charged? And then what do they provide? What service do they provide for this fee structure? Because the reality is that a lot of property management companies barely get by with the fees that they charge, with those 5, 6, 7% fees, especially the companies that charge the low fees. Quite often what they'll do is they'll charge the low fees to attract the business, but then they'll have a lot of hidden fees within their contract. Fees such as a fill rate. And a fill rate is a fee that they charge when there's a vacancy and they fill that unit. It could be 50% of the rent, it could be 100% of the rent, who knows, but that's going to be laid out in the contract. You want to make sure you understand that. What is their after-hour service program? Do they have a service 24/7? And how are they going to be reporting to you? Are they going to be reporting on a weekly, monthly, quarterly basis? How are they going to be reporting? Do they have a set form that they fill out and they send off to you? Are they going to be collecting the rents, paying the bills, or are they going to be collecting the rent, putting them in your account, and you pay the bills? I prefer the second method myself. That's how we operate our property management company, so that the owners of the properties are responsible for paying their own bills, and we just manage the property itself then. Then we talk about lawyers. Now, a lot of people think, they see the lawyers on TV and they think that's the life of a lawyer. Well, that's rarely the case, actually. Lawyers spend a lot of time going through paperwork. They're just drowning in paperwork. Very rarely do they ever actually get out into the courtrooms. So to truly understand what a lawyer's job is, it's to protect your interest with respect to the real estate transaction. They're looking for any hidden issues that could come up and cause you harm, cost you money. And then ultimately, if there is a conflict, a tenant sues you, or the property doesn't close for whatever reason, they can defend you in the case of a conflict like that. So it's definitely important to have a good quality lawyer on your team. So I get a lot of people asking, well, what level of experience? Should I go for a young lawyer, an old lawyer? Should it be a small firm, a large firm? Well, there's really no straight, easy answer for this. I've done both. I've worked with older lawyers in small firms. I've worked with older lawyers in large firms and vice versa. So currently what I have now is I have a very young lawyer. I've had several young lawyers actually, and I do like the young lawyers because they're open to change. They don't have a closed mind. So if I bring a new concept, a new idea to them, they don't automatically say, no, you can't do that. That's not how it's done. A lot of the older lawyers are pretty set in their ways. They've got lots of experience, but they're not open for new ideas. So I like the young lawyers. They're full of vim and vigor as well, and eager to learn. My current lawyer is actually becoming an active investor because he sees what we're doing and the people that we work with, and he's inspired by that. He's done a lot of stuff for us. I've given him a lot of business, both with my students and clients, and he does a lot of stuff for us personally. And when he gets stumped and he needs to draw on some experience, he's got the experience from the rest of the firm. There's some very experienced older lawyers in the firm that he can draw on. And like a doctor, one doctor doesn't cover it all. You've got brain surgeons, foot doctors, you've got all kinds of different specialties. Well, the lawyers are the same. So you've got real estate lawyers, and that's who you're primarily going to be using as a real estate lawyer. You've got landlord and tenant lawyers, which you hopefully won't have to use, but at some point in time you may have to use a landlord and tenant lawyer. These are lawyers who specialize in the rules and regulations between landlords and tenants. Then you've got your corporate lawyers, and again, you may or may not use that. Depends on the size of your company if you decide to incorporate or not. And hopefully you'll never need the services of a civil, criminal, or tax lawyer, but those are the different types of lawyers that are out there. Then we have an accountant, and again, accountants are different specialties as well. So you've got your public accountants, and that's primarily who you're going to be dealing with. Then you've got your tax professionals. These accountants deal with the governments and the taxes that the governments charge, and we as individuals have to pay. And then you've got your forensic accountants, and then a forensic accountant is one who will go back in the books historically for several or many years to make sure that all of the bookkeeping was done properly if you're buying a business, as an example. For real estate, not a big deal unless you're actually buying the corporation that holds the real estate. Then the forensic accountant can go back and look at the books for the corporation a number of years back to make sure that all of the taxes have been paid properly. Then a financial advisor is an accountant who deals more with personal finances and investments, and just a different stream altogether. So as I said earlier, we're going to be dealing primarily with your public accountants. That's your certified professional accountants, certified general accountants. There's all kinds of different acronyms out there for the accountants. In an ideal world, you would love to have an accountant who is an active investor as well. And for myself, our accountant is an active investor, and he actually took a lot of the same real estate education courses that I did. And he doesn't own quite as many doors as I do, but he knows the business. He understands the game. And the reality is that there's a lot of tax advantages and breaks that the average accountant may not even be aware of because they aren't an active investor themselves, and they're not in the game full time like my accountant is. If you can't get an accountant who's an active investor, the next best thing then would be to find one who's working with multiple investors and understands the game. And again, talk to other investors to see how they feel about their accountant. In support of the accountant, you have your bookkeeper, and they work very closely with your accountant. So the bookkeeper works over the course of the year to create all of the books that are then delivered to the accountant for the year-end work. Again, in a perfect world, it would be great if the bookkeeper understood real estate investing or was an active investor themselves. You want to make sure that they're proficient with a software package that the accountant is using as well. I mean, there's nothing worse than having your bookkeeper use one set of accounting software and your accountant use a different set of accounting software. You want to make sure they're both on the same page. You want to make sure that they're very detailed and organized. For somebody like myself who's not that detailed and organized with respect to the paperwork, I need to have a bookkeeper take on that role and that task for me. They make sure that the payroll and the taxes get remitted to the government in a timely fashion so that I'm not paying penalties. Plus, I'm not having the government come in after me 2-3 years later saying I didn't pay enough taxes. So you want to make sure you stay on top of these things. Now, with respect to the bookkeeper, the accountant, and the lawyer, how do you find these individuals? When I started to grow the portfolio, my accountant came to me or mentioned to me that he no longer felt comfortable managing our books because it was getting too big for him. So he recommended that we find a new accountant. And at the same time, I needed to find a new lawyer. So what he suggested was, well, here's 3 accountants you may want to interview, and interview more if you wish. And ask them the questions, let them know what your plan is, and listen to them and find out, whether there's a good fit just on a personal level, your gut. Do you like the person? Are they going to spend the time and help you? Or are they just going to sit there and crunch the numbers for you and treat you like another number in the queue sort of thing? You want to make sure you've got that strong relationship. And once you've decided on what accountant you want, then ask them for references for a bookkeeper. Because again, as I said earlier, the bookkeeper and accountant work hand in hand. But the bookkeeper, or the accountant rather, and the lawyer are going to work hand in hand, not as closely as the bookkeeper, but they do need to communicate with each other and be on the same page. So I also asked my accountant for 3 references for lawyers, and I went out and I interviewed those 3 lawyers to see which one that I liked. I've since changed lawyers, but it provided me a good start as to who I should be interviewing, because just to go to the internet or in the phone book and look up lawyers, you have no idea who's a decent fit at all. At least once the accountant knows who I am, what my business is, they can point me in the right direction. All right, the next team member is going to be somebody for your finances, whether it be a bank or your mortgage broker. So with banks, and we're going to talk about finance more later on in Module 2, but very quickly here, what the bank brings to the table is one lending source. They are the bank, and they've got their own set of lending criteria to follow. They also have internal limits that they apply as well. So they might say that small investors with a portfolio of 5, they won't invest to investors with more than 3 or 4 properties. That's their internal limit. Or another bank might have an internal limit where they'll lend up to 8 units. It all depends. And the frustrating reality is you don't know what those limits are because they don't advertise them, they don't market them. Their fees for lending are relatively low because they're counting on getting the business. They're not only counting on getting the business of the mortgage, but they're hoping that you'll do all your banking with them as well. So the downside with the bank is that they're very, very, very structured. They've got the set of pigeonholes, and if you don't fit into those pigeonholes, then you're declined right off the get-go. Doesn't matter how good your credit score is, doesn't matter how much money you bring to the table. If you don't fit their criteria, then you're declined. I was speaking with a big bank about a year ago, and she shared with me a stat that just blew my mind. She said that almost 50% of the conventional mortgage applications are declined. And when I say conventional, I mean like single-family home ownership. Almost 50% of them are declined. Now, in the old days, when a person was declined, they used to have to go to a mortgage broker and go to subprime lenders to get their financing, which meant they had to pay higher fees. They had to pay for the mortgage broker, and they had to pay for a higher interest rate on the mortgages. That's no longer the case. Today, mortgage brokers are doing a lot of primary lending. So they're the lender of choice. People will go to a mortgage broker versus a bank. And a mortgage broker, the nice thing about a mortgage broker is that they have well over 50 different lenders, probably close to 100 different lenders. You can see at the bottom of the screen here, I mean, there's a whole pile of people. There's a lot of names in there that I've never even heard of before, but these are a sampling of the different lenders that are out there. It could be insurance company, it could be credit unions, it could be private money. There's all kinds of different lenders available out there, and the mortgage brokers have access to these people. When you go to a mortgage broker, they're going to take your application and they're going to pull your credit report once. They're going to take that application and your credit report and they're going to shop it around to all the different lenders that they feel would be a good fit for the type of mortgage you're looking for. So they're not going to send it to 50 lenders, but they might send it to 5 or 6 and see who comes back with the best rates, who's the best fit for you. The nice thing about it is that you're only getting your credit report hit once. And every time you have it hit by a mortgage broker or a bank, it has a negative effect on your score. When you go to the bank and you get turned down, you have to go to another bank. That means they pull your credit again. So you might have to go to 3 or 4 banks before you get a bank to say yes. But in the meantime, all of these banks are going to see that you've been shopping around for financing and you must have been turned down because it all shows up on your credit report. With a mortgage broker, you get one report, one credit report, and so it impacts your credit score much less. The mortgage brokers then will apply to all the different lenders, and these lenders could also be the big banks that you were just declined at. They could be going back to the big bank with your same application, and so you're not going to the subprime lenders necessarily. The interest rates could be as good, if not better, than what the big banks are offering as well. One of the biggest things that you want to make sure of when you are going to a mortgage broker, the first time you go and you introduce yourself and you're interviewing the mortgage broker, you want to make sure the mortgage broker is showing an interest in asking questions about your plan. How many properties do you plan on buying? Where's the money going to be coming from? If they're just interested in getting you the one mortgage one time, then that's not the mortgage broker for you. Next, we have an appraiser. Now, an appraiser is a third-party independent person who is certified to go out and look at your property or a property to determine the market value of that property. And the way they do this is they go out and they look at, well, they first of all assess your property. Then they go out and look at other properties that are on the market that are either for sale and or have sold recently, excuse me, that are very similar in size, features, and with any changes in features or size, they'll make adjustments plus or minus, and they'll come up with a value for your property. Now, the key here is that it's an opinion. It's their opinion, and it's their opinion based on their experience. And it's a very valuable opinion, and they can actually get it narrowed down pretty good. However, what they do is they have an opinion based upon a high and a low range of properties that are out there. Now, why do we need an appraiser? Well, first of all, appraisers are required by the lenders to confirm the value of a property. So when you go to any of the banks to apply for a mortgage, the bank is going to hire the appraiser to go out and confirm the value of that house is actually what you paid for it. Because the lenders do not want to lend out more money than what the property is actually worth. It's also used by you, the investor, when you're creating secondary financing on the property with private money. You want to make sure you want the property value to come in at the high end so that there's more equity in there that you can place a second mortgage on the property, and the person who's placing that second mortgage is going to feel comfortable about the value of that property. Now, you can't tell the appraiser how much, how to do their job. However, you have to understand that the appraiser is going to answer to whoever's paying them. So when the bank hires the appraiser to confirm the value for financing, the appraiser is working for the bank. The appraisal goes to the bank, and you never see the appraisal. When you hire the appraiser to do an appraisal for your secondary financing, they're now working for you. They're going to ask you, what's the purpose of the appraisal? Well, it's interesting to know why does it matter? I mean, the value is the value, right? Well, not necessarily. Because when you take a look at this picture, there's the house itself and what it's worth to you in the top right corner there. So that's a pretty nice looking house. Well, the lender, they don't see it quite the same as you. Therefore, they're not going to give it quite the same value because they deem it to be at a risk. Their money's at a risk, so they want to make sure that it's a little bit less. Then if anybody's looking to purchase the property, it's way less. That's negotiations. So if a person wants to buy your property, they may have an appraisal done, pay for the appraisal, and they're going to tell the appraiser to come in at the low end of the scale. And then, of course, there's the tax assessor. When the tax assessor comes out to appraise your property, it's going to be a castle compared to what you believe it is. So if you want to fight your taxes, then you're going to want to have the appraisal. You're going to hire an appraiser to come out and do an appraisal, but you're going to want the appraisal to look more like the purchaser's appraisal. So it's a little bit of a game, and these values can be, as I say, there's a range, high and low range, and that range can be quite significant in some cases. So I thought I'd do an example for you here. So let's say that there's a house and the market value is $380,000. It's on the market for $380,000. The real estate agent believes that's what it's truly worth, but you've been able to purchase it for $350,000 because you're a fantastic negotiator, or the sellers are actually motivated and they need to get out sooner than later. So you pick it up for $350,000. You're going to finance it based upon the $350,000 purchase price, which means the bank's going to lend $80,000 or 80%, which is $280,000. The bank's going to send out an appraiser, and I would be willing to bet money that the appraisal will come back with a valuation, suggested valuation of $350,000 to $360,000. That's at the low end of the scale, so the bank is happy. Now you want to pull after you own the property, you want to pull your 20%, that's $70,000, back out of the deal so you can go and do another deal. You want to replace your $70,000 with a second mortgage from, say, a private lender, somebody who's going to use their line of credit, or it could be their retirement funds that you're going to use in the form of a second mortgage. So you want to do 100% finance based on a $380,000 valuation. So you hire an appraiser to come in and you say, I bought this property for $350,000. It's worth $380,000. I'm going to refinance it. So I want the market value to be as high as you can justify. I'm not asking you to lie. I just want it to be in the high end. So the appraisal comes back at a valuation of $380,000. You're just looking to get your $70,000 back out. So now you've got the property is 100% financed for $380,000, but it's worth $380,000 according to the appraisal. That's at 92% loan to value. So now your investor who's investing that $70,000 feels very comfortable because they know there's still additional equity in that property and they're only at a combined 92% loan to value. So that's the value of using an appraisal to your benefit and how you do it. All right, the next person on your team is a handyman. So you want somebody who is affordable, but key here is don't be too cheap, because if you hire a person who's really, really cheap, you're going to get cheap quality work and you're going to end up going back in and having to fix it or hire somebody else to go in and pay twice to have the work done. So quite often you're better off to pay more than what you may be prepared to pay. For us personally, we can get handymen working for as little as $15, $16 an hour, but the quality of their work is terrible. We've paid as much as $40 an hour, which is almost as much as what you would pay a professional, but then the quality of their workmanship is very professional. And we've also discovered that when you get a good handyman who charges a lot, they're in demand. So they can afford to charge a lot, but they're also hard to get. Whereas the ones at $15, $16 an hour, they're easy to get, but the quality of the work is bad. So you want to pay them what they're worth, and when they're done the job, don't delay paying them. Pay them right away, because these people tend to live paycheck to paycheck, and if you pay your bills right away, then guess who they're going to come and work for in future. These handymen need to be capable of doing the minor things like taps and toilets and plug lines, etc., or maybe basic electrical like changing plugs and light fixtures. They need to be able to do some minor carpentry, be able to hang a door, put down laminate flooring, etc. Definitely painting or general cleanup. A good place to find a handy person, other than just on your internet sites like the Gigi and so forth, is obviously the local free newspapers is a good place as well. But early in the morning, I'm talking 6 o'clock to 7 o'clock in the morning, go to the local coffee shops, especially if they have drive-throughs, and just watch these contractors driving through and have a notepad there. Start writing down the names of the contractors as they drive through to pick up their coffee to get their day going. All right, another team members are your joint venture partners or your money partners, and we're going to talk a lot more detail of this later, but for now, just high level. You're going to focus first and foremost on your family, friends, your work colleagues. That's your closest circle of influence to you. And what you're going to do for some of your homework here is you're going to create what we call an opportunity list. An opportunity list is just identify anybody and everybody you know currently that's close to you, family, friends, colleagues. And underneath their name, you're going to write how much you believe they have in savings, whether it be retirement savings in their mutual funds or whatever, or access to a line of credit because their house is virtually paid off. That's cash as well. You may or may not know, but you may have a sense. So you write this down. And it's not that you're going to go knocking on their door and ask for money. That's not the goal here at all. It's just to identify who potentially has money, because these are the people that you're going to pay special attention to moving forward. Keep people in your circle of influence informed about what you're doing. That could be through newsletters. It could be through having a small barbecue, inviting people over, do a little presentation. And the bottom line is you educate them. And I don't care how you educate them, whether you give them books to read, do a presentation. One thing that I love to do is play the game Cash Flow 101, which is a game that Robert Kiyosaki has created. And it's a game about investing. And we play this every 6 weeks or so. We invite people into our home, and we'll have anywhere from 10 to 20 people playing the game. We try to get new people coming in all the time, and I'm educating these people. As a result of me educating these people, over time they develop a level of trust with me, comfort, and understanding, and then they ask if they can invest with me. I've raised hundreds of thousands of dollars doing this. And our last one now is going to be the personal development. Now, this is one that we touched on in a previous lesson as well, but again, this is an extremely important member of your team, whether it be this particular program or any other mentor or coach in the industry that you're looking to grow in. Extremely important to have a personal development mentor and coach supporting you. So that's it for this lesson. Again, any questions, please hold off until we go through the webinar. And if the questions have not been answered during the course of the webinar, then by all means, feel free to email me at ken@5homestofreedom.com with those questions, and I'll be more than happy to answer them. So until next time, take care.